Hello, everyone. Welcome to our webinar today on blockchain applications in supply chain and finance. I will be the moderator for today's webinar and also will be the first presenter. And my name is Fasheng Xu. And today we're very excited to have our guest speaker, Rowena, join us from Dallas. And let me start with a brief introduction about myself and also about our guest presenter. So I'm assistant professor of supply chain management at Whitman School of Management at Syracuse University. I got my PhD from WashU, and also my research interest has been focused on this interface of operations, finance, and economics. In particular, I'm interested in blockchain adoption in supply chains and also tokenizations and some information economics. And at Syracuse, I'm teaching the Introduction to Supply Chain Management course. And our guest speaker, Rowena, is assistant professor in this information technology and operations management department at SMU. And she got her PhD in operations information and decisions from the Wharton School, University of Pennsylvania. And she also have a bachelor degree in mathematics and a minor in music from Duke. She has been actively working on projects in these blockchain technology, cryptocurrencies, and their influence on businesses. And more general, her research also includes revenue management, service operations, and strategic agents. At SMU, Rowena has been teaching a master level course, blockchain and cryptocurrency in business. So let me first give an overview about what we're going to do today. So for my part, I'm going to first talk about, in general, why do we need a blockchain, and then focus on a few use case of blockchain and try to see why do we need a blockchain in a supply chain setting. We originally planned to have some introduction to Web3 and DeFi, but due to time limit, probably we are going to skip that part for today's session. So let me start with the question, what is a blockchain and why do we need a blockchain? If I'm asking you this question, many of you may come up with blockchain buzzwords, and those are kind of decentralized or decentralization, immutable, and censorship resistance, secure, trustless, and scalable. So all those are some kind of buzzwords you can learn from social media if you search about blockchain. But the key question here is that first, those buzzwords are not necessarily the features of all types of blockchain. Some of the blockchain, they are not completely decentralized. Some of the blockchain, they are not completely secure. So the second question is, so what? Why do we want these features? If we think a little bit more about fundamental concepts behind the blockchain, we can define blockchain as the following, or what is a blockchain good for? The short answer is a blockchain can provide a method to coordinate among many parties when there's no single trusted party. So here the key term is trust. So basic idea is blockchain can help you build trust. And here is a screenshot shows that from these Goldman Sachs website, they provide a very nice introduction about what is a blockchain. Here they call blockchain the technology, the new technology of trust. So the key idea here is whenever we talk about blockchain, the first word comes into your mind should be trust instead of those buzzwords. So next, let's talk about a key term, several key terms regarding blockchain. The first one is what is blockchain, and then cryptocurrency, token, and smart contracts. And since we're not going to cover token and cryptocurrency, I will just briefly talk about what is a blockchain and also what is a smart contract. So blockchain, you can think of it as a verifiable distributed ledger maintained by a distributed network. And more importantly, it is the technology behind all those three terms: cryptocurrency, tokens, and a smart contract. We all know about Bitcoin, and Bitcoin is one of the best known cryptocurrency using this blockchain technology. And more general, token can be defined as a digital record of ownership of particular digital goods or physical good. And here, a smart contract, brief introduction about smart contract. It is a digital contract that can allow contract terms contingent on decentralized consensus, and it is self-enforcing and tamper-proof because of this automatic execution feature. So what I want to highlight is that based on this definition, blockchain is not equivalent to Bitcoin and also not equivalent to cryptocurrency and tokens. So those are different concepts. And smart contract is not smart. When I say it's not smart, means it has nothing to do with AI or those artificial intelligence. So it's purely digital contracts. So next here is a brief introduction about this, what we call the blockchain trilemma. The key idea is that whenever we design a blockchain, it's hard to achieve all three of these features. One is security, the second is decentralization, and third one is scalability. And we're going to focus on those blockchain, the blockchain applications in supply chain. They are mostly based on the hyperledger, and this one you can see on this right-hand side, which means it's not completely decentralized. And also because of the trilemma, it's easy to see that one feature is security, then it means not all blockchains are 100% secure. So there's a misconception that when people talk about blockchain, they may think blockchain is 100% secure. Here, we just want to clarify this is not, depends on your trade-offs among the three features. So next, I want to highlight not all blockchains are public and energy intensive. When we talk about blockchain, many people may think it costs a lot of energy, a lot of electricity because of the proof of work mechanism for Bitcoin. But we want to highlight in many other different settings, the blockchains can be much less energy intensive. And also, as you can see here, there are three types of blockchain we're going to see. One is permissionless blockchain, and that's the first one is permissionless. The second one is public permission, and the third one is private permission. So what we're going to focus on in the supply chain domain, most of the applications is based on the private permission blockchain. Okay, so after a brief introduction about what is blockchain, next let's focus on why do we need a blockchain in a supply chain setting. A short answer to this question is we need trust-enabled visibility. Or more specifically, we're going to show how these supply chain visibility issues can be resolved by the trust created by blockchain. So let me start with a brief introduction about what is a supply chain. You can think of all the companies or all the parties involved directly or indirectly in fulfilling a customer request or customer order. So this is a supply chain. And what you can see here is we have a supplier, manufacturer, distributor, retailer, and finally the consumers or the shoppers. And a more concrete example here is the detergent supply chain. You can see it includes customers go to Walmart store and go upstream its Walmart distribution center, and then there are manufacturer like P&G, and also there's some raw material producers. So this is a very kind of simple supply chain for this very simple product. But things becomes way more complicated if we look at the firm level. Let's look at Walmart supply chain. So this is how Walmart supply chain looks like. It's like a very complicated network. There are many firms linked to Walmart, and then those firms were linked to other firms as well. And here, I give you another illustration on the right-hand side is Walmart have their tier 1 supplier, and then the tier 1 going to have the tier 2 supplier. So in the next in this presentation, we're going to talk a lot about this tier 1 and tier 2. Here is an illustration about what do we mean by tier 1 supplier and what is a tier 2 supplier. So tier 1 supplier is just Walmart's direct supplier, and the tier 2 supplier is a tier 1's supplier. When we say supply chain visibility issue, that means the Walmart does not know who are those tier 2 suppliers, and that's a typical of the case in practice. And when we go to the deeper of the supply chain, let's say tier N supply chain, tier N suppliers, and then it's even harder to know who they are and to have a complete supply chain visibility. And if you ask these global supply chain executives, the answer is that yes, those visibility is indeed the biggest challenge they have for their supply chains. So what we're going to focus on today is three different use cases, talk about three important application areas. The first is traceability, the second is transparency, the third is tradability. And throughout my presentation, you will be able to see how the trust-enabled visibility can create these values of blockchain application in supply chain. So let me start with the first application, traceability, where we typically use that for product recall. So this is a background story about the food contamination is a long-standing problem in the United States. What you can see here is the data from FDA and the CDC saying that almost every year there are a couple of foodborne illness outbreaks of E. coli, and it's linked to these leafy green products. And there are two specific examples reported from Wall Street Journal. What you can see on the left hand, on the first column is that in 2006, there's a spinach, and it caused the infection cases close to 200, and also more than 1 people go to hospital and even 3 deaths. And it affected more than 20 states. And in more recently, in 2018, there's a romaine lettuce issue. It is at a very similar scale. So you can see that this kind of food contamination can lead to very important public health concern. In addition to health concern, there's also revenue loss for those farmers. What you can see here is in these two examples, it causes kind of more than $100 million losses to all these farmers. Then you may ask why there is a huge loss for those farmers, because we're talking about leafy green supply chain. They're perishable products. So once we identify this contamination in the end market to ensure food safety, what we can do is to destroy and put off shelf all the suspected vegetables or fruits. Because they're perishable, so it's equivalent to destroy all of them. And the second feature, as I mentioned earlier, for this kind of leafy green supply chain, using Walmart's example, you can see Walmart knows who are those tier 1 suppliers, but they don't know who are those tier 2s. And because of this lack of traceability, the identification process for contamination is very time consuming. Combined with the perishable feature, we lead to this large revenue loss for those farms who originally produced these leafy green products. So what is the solution with blockchain? So Walmart adopted the blockchain and claimed that they can pinpoint the original source of food contamination during like a few seconds, compared to before blockchain adoption takes more than a week. And because of this fast traceability, we can eliminate unnecessary food waste due to the lengthy process of contamination identification. So which will save a lot of potential revenue loss for those farmers and also for Walmart. So then you may question why a centralized system failed in this case. So thinking about a Walmart's example, Walmart may ask the tier 1 supplier to ask them who are those tier 2 suppliers and ask everyone join a centralized digital platform. Why this does not work? The key reason is because the tier 1 does not have incentive, or they may resist to tell you who are those tier 2 suppliers. To give you one example, that is after the 2011 Japanese earthquake, the Toyota tried to get the complete picture about the supply chain because of these visibility issues. But after the effort, only half of the suppliers are going to join the platform. And the key reason is still because of trust. The tier 1 are redundant to share tier 2's information because they're worried the downstream buyers may erode in their margins, because if they know the pricing, the tier 1 get transaction price between the tier 1 and tier 2, they may strategically kind of change their price. And also the tier 2 are also not comfortable sharing their sensitive transaction information, in particular in a supply chain setting, due to the concerns over security and also privacy issues. But blockchain is not necessary in many other cases. For example, in this example for Subway, that they determined to use this barcode with this GS1 technology instead of blockchain. Why they prefer not to use the blockchain? In the Subway case, we don't have such multi-tier visibility issues, and also in many cases we don't need that fast traceability capability. So the keynote here is that when we talk about traceability, traceability enables these blockchain-enabled traceability, we need the following two conditions to justify the blockchain adoption. The first is we need visibility in the multi-tier supply chain. The second is we need the traceability speed. Essentially, we want to have a very fast traceability. If not, then we don't need blockchain. So next example is the transparency. or information sharing, which can help you provide a product provenance and also authenticity in different types of supply chain. So here is an example of what we call the luxury blockchain. That is a platform co-developed by LVHM and Microsoft and another leading Ethereum infrastructure developing company called Consensus. So they developed a platform called Aura, which can provide authenticity of the luxury items to battle against counterfeit and also potential fraud. So if you think about in this case, why do we need a blockchain? It's still about this trust. So because we want to achieve a complete visibility about the product journey from the original manufacturer, even raw materials, to who are those previous owners. So we want to have a complete visibility of the whole product journey and also all the transactions related to that product. And if you ask a consumer to use a centralized platform, they may worry about the trustworthiness of this centralized platform. So if you use blockchain, it's easy to build trust. And in particular, this kind of trust is very useful in the secondary market when people trade and transact of the used luxury items. So the last category of application is called tradability, or what we can call it as asset tokenization. So let me give you one example, that is accounts receivable tokenization. Before that, let me first introduce what is accounts receivable. So typical process of firm transaction is that after seller deliver the product to the buyer will not deliver immediately pay the seller. Instead, they're going to pay after a certain period of time, let's say 3 months or 6 months, and this is called trade credit. And if you look at these during this period of time, what the company have on their accounts on the balance sheet is the accounts receivable, the accounting term, and this is actually a very significant portion of firm's total assets. On average, it accounts for 14 to 20% of firm's total assets. But if during this payment delay period, those sellers, they may need working capital for liquidity issues or for other investment opportunities. What they can do, they can adopt a factoring, essentially to sell accounts receivable to a third-party financial institution, what we call a factor, to obtain immediate cash, but at a certain discount. So what is accounts receivable tokenization? Thinking about still there are multi-tier in this supply chain where we have an anchor large auto manufacturer, Toyota, and we have a tier 1 supplier and also tier 2 supplier and even tier N supplier. In the traditional world, without this tokenization, what you can do is just issue invoice after they deliver the product to you. But with this tokenization, we can develop a platform where we can tokenize those invoice into a token where the downstream Toyota just pay the tier 1 supplier with this token, and then the tier 1 can split and transfer some of the token to the tier 2 supplier as a payment, and the tier 2 supplier can do similar things. And whenever one of the upstream suppliers, let's say tier 2, needs working capital, they can sell those tokens to the platform and get immediate cash. So the key advantage here of this accounts receivable tokenization is you can use it depending on your liquidity request. Essentially, you can either there are 3 options. You can sell to the platform, get immediate cash. You can pass on as a payment instrument, or you can wait if there is no liquidity issues. You can wait until the buyer pay you in a regular kind of setting. So to summarize, these accounts receivable tokenization can benefit the tier 2 because now the token is issued by the large corporate buyer like Toyota. So when you sell those tokens to the financing platform, you can get a much lower interest rate compared to the case you adopt a traditional factor. The tier 1 can also benefit because the tier 1 can use that as a payment, directly pay the tier 2 instead of hold the payment liability in the traditional world. So then you may also ask why we cannot adopt a centralized system to achieve this. So the key issue is still because of the visibility barrier issues. So what you can see here is that if we don't have a visibility about all the transactions along the supply chain, then if the tier 1 use an invoice from Toyota to pay the tier 2, how can the tier 2 trust this is a kind of a good accounts receivable instead of rather than a fraud? And what we noticed that in practice, there are many such kind of double financing fraud for accounts receivables. So in order to avoid such issues, you need to build a trust. You need to achieve the visibility about these accounts receivable, and blockchain can enable you to do that. And there one minor benefit, that is the tokenization can also makes it easier to transfer a fraction of the assets to the upstream. It basically means a more flexibility in these token transfer versus traditionally you use the invoice to pay the tier 2. So again, here still we're talking about trust and enabled visibility, but this time the visibility is for this accounts receivable. Okay. So the key takeaway from my talk is the answer to the following 2 questions. The first is, why do we need a blockchain in general? The answer is we need a trust. In addition to all those buzzwords, all those features of blockchain, I hope the first word comes into your mind next time when you think about a blockchain is trust. So the second question is, why do we need a blockchain in a supply chain? I give it examples focused on 3 categories or application areas. One is traceability, second is transparency, and last one is tradability. But at the end of the day, we need a blockchain in supply chain is because we need blockchain to help us build trust, which will enable us to achieve the complete visibility of the supply chain. The visibility could be between different supply chain firms or between firms and consumers. So one more slide, some concluding thoughts that blockchain, crypto, all those buzzwords, but they're much more than hype, fraud, or these Ponzi schemes. So blockchain is an infrastructure that can help digitalize supply chain and also can act as a middleman of many different enterprise systems like database or ERPs. Even though cryptocurrencies hijacked many blockchain-related headlines, but we want to emphasize blockchain technology itself behind this cryptocurrency can be applied to many other different settings. Essentially, we can adopt the blockchain without cryptocurrency. So lastly, the science of blockchain continues to generate exciting research opportunities, not only in computer science, but also in economics, finance, and operations and supply chain as well. So that's all for my part. And next, let's welcome Rowena to talk about tokens.
Thanks for the invitation. So I'm going to talk about the hijacker part of blockchain. So hi, everyone. My name is Rowena again. I'm from the Cox School of Business at SMU. I'm honored to be here. So just now, Fasheng gave a very nice overview of the blockchain technology and applications in the supply chain. Now, let me focus on just one application, which is the hijacker, which is really something that's native to a truly decentralized blockchain. And that would be crypto tokens. Okay, so crypto tokens. These are tokens. And tokens are really everywhere in our life. In theory, there could be as many token types in digital environments as there are sources of value. So let me first quickly define tokens generally before we explore their specific use in blockchain. So we have the following 4 categories. Fiat tokens, they represent centrally issued government currencies, such as the euro, the US dollar, or the Chinese RMB, and they're used to facilitate the exchange of goods and services. And we should all be very familiar with fiat tokens. So traditionally, these tokens are best known for their physical forms. So we have our cash notes and coins, and it also includes precious metals and commodities. Now, the second category is something that we might be less familiar with, but it's called the process tokens. And they extend the reach of fiat by encapsulating a process necessary to use them in digital environments. So example would be, so you might have noticed that Facebook access tokens, so they're issued to third-party apps when you click the sign in with your Facebook login function, then these tokens encapsulate user sign-in credentials. Then we have complementary tokens, which act as a medium of exchange, but in closed or otherwise limited contexts. Examples include reward points from your airline, right? And also hotel loyalty program points, or known brands like Starbucks, Stars, and Uber Cash. Complementary tokens historically have filled in gaps where fiat tokens did not provide sufficient incentive over the terms and conditions of doing business to the issuer. For example, the goal of loyalty points is to encourage the customer to stick with the brand. But if the reward points are given in the form of fiat tokens, like if it's like in cash, then customers can use the fiat tokens everywhere, not necessarily with the same brand. Lastly, finally, we have cryptocurrencies or crypto tokens. And these are digitally native currencies that replace both fiat and process tokens and can be used to create new forms of assets. And this category will be our focus today. Okay, so you might have heard people using different terms to describe the same thing. Now, what's exactly the difference between these two terms, cryptocurrency and crypto token? So let me say a few words about the distinction between the two. A cryptocurrency is a form of code that's supposed to represent some kind of value. Or you can think of it as a digital version of money that is supported by the blockchain technology. And a good example is something like Bitcoin, which is designed to be used as a medium of exchange. Many people are using it as a store of value on a relatively rare occasion, but basically it's supposed to represent value in a sense like a dollar bill or some kind of asset, or even gold, but in the form of a code that is scarce, that doesn't exist in an infinite form. We then have another form of crypto that many people call coins or tokens. And these are codes that when used in a particular system will perform a particular function. For example, you could imagine an environment in which you can store your data on the internet, but on other people's computers. So it's a little bit like Airbnb, but for your data instead of for your body. And when you've got that kind of a system, you're going to have to pay the people who are providing their servers for the use of their servers. And you can use tokens or coins to transfer that value in that particular system. So in case you know, so there's a company called Filecoin, and they're doing exactly this. In addition, you may be able to pay within a game with tokens. And there could also be tokens that are designed specifically for ride-sharing systems. So technically, one could imagine and even construct tokens that could be used for just about any economic function, in addition to the store of value. Okay, next, we come to another notion, initial coin offerings, or ICOs. ICOs are an important application of blockchain in the finance industry. So what exactly is an ICO? To put simply, it is just a fundraising method. And you can think of it as crowdfunding, but on the blockchain, where tokens are sold to retail investors. So here's a timeline of a typical ICO. So a startup company first publishes a white paper detailing why their idea is great and how they will create and issue tokens. Then the company issues its platform-specific tokens as per the white paper. And these tokens can have a variety of uses, and we will discuss them later. But regardless of the token type, during the token crowd sale, investors purchase tokens using either fiat currencies or more commonly cryptocurrencies such as Bitcoin and Ether. And these Bitcoin and Ether are sent to a published address, and a smart contract sends the platform-specific tokens back in return. Now, the firm, after selling some portion of its tokens, obtains a bunch of cryptocurrencies, which would then be converted into fiat currencies so that the firm can fund its production. There are many reasons why a company chooses ICO over other forms of financing. And one of the most important reasons could be that they want to leverage the blockchain technology. If this doesn't make sense to you yet, just imagine somebody who wants to build a system that allows you to use tokens to make restaurant reservations. So you get paid for making reviews. You can get maybe premiums or discounts for ordering special drinks or hosting a big party. So they build these tokens, or they plan to build these tokens, and they tell people, look, we will sell you tokens for a system that doesn't yet exist. And we will sell you these tokens, and we will raise a certain amount of money. And when we raise that money, we will use it to launch the system, or maybe build the restaurant or an app, and you will have the tokens that you can use them in the system. And people have been raising lots of money around these initial coin offerings. But note that it's similar to selling stock, but it's not really selling stock here, because people who buy the tokens don't have any voting rights. And all they are doing as a practical matter is buying the future inventory or future service. But in most situations, they're buying the inventory or service at a price that they hope will appreciate. So one might want to ask, do these actually work? So I'm showing some data here. Here's a table that compares the market sizes of ICOs and other financing methods. So ICOs have experienced tremendous growth over the past few years, and they have formed a huge market. So you can see my cursor, but in just about 3 years, from 2016 to 2018, ICOs based in the US grew from a non-existent state to 1/6 of the IPO market size. So that's the second line in the left table. Now, in the right table, where we show the average amount of money raised, we see that the average amount raised in crowdfunding, so like in traditional crowdfunding, like Kickstarter or Indiegogo, that's like $10K US. But the average used in raised in an ICO is, so if you look at globally in 2018, it's $11.5 million US. So yes, ICOs are indeed a viable method of fundraising. Now, you may want to ask, why do we actually need tokens? We know that for the company that develops a blockchain-based project, the company needs to sell tokens to investors or the users. And that is initial coin offering, because they want money. They want to do fundraising. But how about the users? What do the tokens actually do for them? So here are a few main purposes that most crypto tokens are designed to serve. Now, the first purpose is to aid decentralization. Here, by decentralization, we are really referring to a more equitable way of reward allocation. So let me give you an example. So in the social media industry, there's a website called Steemit. So this is a blockchain-based social media site. It is similar to Facebook or Reddit, but where you can post messages, and your friends can also see your messages, and they can choose to give you a thumbs up or maybe upvote if they like your content. Now, what makes Steemit different from Facebook, other than the fact that it is supported by the blockchain technology, is that Steemit rewards content creators with a certain number of coins they can when they upload content. Also, as a content creator, you get more tokens over time as more participants view and like your material. Now, does this incentivize people to upload better content? Maybe. I don't know. So I don't have the stat and I haven't done any research on that, but this probably allows non-famous content creators a better chance of profiting from their own content. As a result, the platform attracts a larger crowd and probably better content. Anyways, we can extend this concept to other industries as well, including esports, so that platforms could reward gamers for winning or for popularity with the esports audience or for their sportsmanship. You can also extend it again for retail or experience brands. You could see ways to cultivate brand loyalty by rewarding customers for posting pictures of themselves using the product. Next, tokenization can also produce rewards through data monetization. We know that in traditional centralized systems, we as customers don't have much control over our own data, not to mention profiting from your data, right? But internet users have become increasingly aware that their digital behaviors are captured, stored, analyzed, and sold to advertisers and product developers. Now, with blockchain, we can utilize tokens to value and trade data assets. On the blockchain, tokens can also allow decentralized peer-to-peer data exchange on a global scale, using a mechanism that equips data owners with the ability to keep their data private until they give explicit consent to a peer to view it or use it. One blockchain solution that provides users more control and oversight over data comes from Data Wallet. I believe it's a US-German startup with a mobile app that allows participants to agree to share pieces of their personal information with marketers in exchange for a digital token. So Data Wallet's pitch to participants is that they will be paid. Their pitch to the advertisers is that the information will be timelier and more relevant than the information they can get from some data brokers. In this way, the users are connected with their data and the ownership is recorded in the blockchain. And these are fundamental requirements for data markets. Earlier, I said cryptocurrencies can be thought of as representation of value, a representation of value. Crypto tokens can represent values as well, and in a similar fashion as cryptocurrencies. For example, some tokens allow blockchain network participants to participate in the network so that they can transact a real-world asset, exchange data, etc. In fact, in most blockchain platforms with platform-specific tokens issued, these tokens are the only viable method of payment. And some tokens can directly represent a share of revenue or profit or an asset. An example in the real estate industry is that there's an expensive building in the Manhattan city, and that building was tokenized, and each token represents a certain fraction of ownership of the building. And lastly, tokens can allow participants to monetize formerly unmonetizable or illiquid assets. For example, your attention towards an advertisement or commercial cannot be monetized by yourself if you just watch an ad on YouTube, right? We know that YouTube is able to charge the advertiser when you watch the ad. but the money is collected by YouTube only. Now there's a company called Brave that creates a browser that pays you tokens when you watch an ad. So these are the four purposes of tokens, crypto tokens. And next, let's see. So crypto tokens come in three main forms. In an ICO, any of these three can be sold for fundraising. First of all, there are utility tokens. You can think of these tokens as user tokens or app coins. So it's like a digital coupon that can be redeemed in the future for transaction or access to a product or a service. An example is the Steam token used in the blockchain social media platform Steemit, the one that I just mentioned. And these tokens can be used to vote. In particular, the more Steam tokens you have, the more your vote counts. Second, we have security tokens, or some people call it equity tokens. So these are the tokens that give their holders a share in the issuing entity, just like a stockholder has a share in the publicly traded company. For example, when you tokenize the expensive Manhattan building, a token represents a certain share of the building and entitles the token holder to a share of the future profit or revenue that the building generates. So this would be a security token. Note that security tokens and utility tokens can be distinguished based on the intended use and functionality of the tokens. And security tokens are usually created as investments. Sometimes dividends in the form of additional tokens are given to token holders each time the issuing company of the tokens earns a profit in the market. And then there are also stable coins, and these are the tokens whose value is pegged to a second asset, such as a fiat currency or a publicly traded commodity or another cryptocurrency. And the most common form of stablecoin is backed by collateral held off-chain or not on the blockchain. And other stablecoins are backed by cryptocurrency. And I probably don't have the time to go into more details. But I hope this very quick intro to crypto tokens at least gives you a better idea of what they are, why they exist, and why they may have value. In case you'd like to chat, please feel free to reach out to me. Thank you.
Thanks, Rowena, for the very nice presentation about different types of tokens. And we see a couple of questions in the chat box, but most of them are asking slides, and there's one open question. So let me answer live. So the question here is that given the current kind of inflation, in particular in the United States, how can this tokenization of AR accounts receivable can be impacted these short-term huge change in purchasing power of fiat currency? So this is related to my presentation. So just want to go ahead and give a brief answer. So the short answer is unfortunately no. So this will not be a solution to the problem, to this inflation problem. So you can imagine what we're doing here is not create a cryptocurrency. We didn't kind of issue a new kind of cryptocurrency like Bitcoin or Ethereum. We simply tokenize the invoice, tokenize the accounts receivables. And the idea is that whenever the tier one going to trade with the tier two, it's still based on the face value of that invoice. So it's not based on a value of types of cryptocurrency. So in that sense, these will not function in that direction to help fight inflation. You can imagine in order to do so, at least you need to have a cryptocurrency. And second is you need to have all participants within your ecosystem to adopt this currency. But unfortunately, in most of the supply chain, you cannot do that. There's either one party is at the most upstream or the most downstream. they still need to exchange with fiat currencies like US dollars. So in that sense, these kind of tokenization will not be able to fight against inflation. Yeah. So I didn't see any other questions. Then I just want to add a quick question to Rowena's presentation. So you mentioned earlier about the very interesting example of one types of tokens where you kind of tokenize a Manhattan, let's say, house or apartment. And I also noticed a couple of weeks ago, there's a news talking about people create an NFT for a physical kind of house or real estate the asset. So just wondering, what's kind of the difference compare this tokenized an asset versus these kind of put an asset on chain as an NFT and then potentially trade? Can you provide any thoughts on that?
Good question. I haven't actually seen houses being represented by NFTs. So NFTs, I'd like to think about them as a representation of some collectible, like an art piece, on which you can generate other products on top of that original piece. So I'm not sure why people are using NFTs to represent a house, but that's definitely doable. But just off the top of my head, I can't say why this could be interesting. But the difference between an NFT and the general token, the crypto tokens that are issued by the Manhattan building builder, is that NFT has its uniqueness, right? So one NFT, that NFT is unique from, so that it could represent one house in particular. But so the example that I talked about in my presentation, that tokens is like a platform-specific token. For example, I split the debt of that building into 100 shares. So I issue 100 tokens. Then you get one token, I get one token. Then our two tokens wouldn't be different at all. So each of them represents a share, the same share of the debt. So that's kind of the main difference here.
Yeah, I think probably that's just one example where people are talking about when there are a lot of discussions around an NFT, and then that's possible that people are trying to hijack the headlines and saying, I'm going to use an NFT to represent real estate, as you mentioned. I think in those cases, it's more kind of reasonable to just use regular tokens where you don't want to highlight the function of non-fungible, because it's just represents an asset value. Then probably if it's fungible, then it's easy to trade and following other kind of transactions based on that asset. Yeah.
Yeah, I think it all depends on what your goal is. If your goal is to create more flexibility, for example, previously without tokenization, a Manhattan building is very expensive, so the investment is only open to maybe some wealthy people. But when you tokenize it, then retail investors can come into the market and they can do something too. So that's the purpose of tokenization in that example. But if you want to treat your house like a collectible, and maybe there are some things that will be I can't imagine what that would be, but something that would be generated on top of your house, then you want something digitally represent that, then maybe NFT would be your choice.
Yeah, thank
you. Thanks for the question.
Thank you for the answering this question. So you see a couple of other questions showing up. Let me see. First, there's another audience provide a very nice link to the example I just mentioned.
Yeah,
Thank you. Thanks so much. We will double check that. The second question is, to me, given the conflict interest between the tier 1 and tier 2 suppliers, Can you explain why blockchain can help incentivize the supply of the tier 2s to share information while the traditional centralized solutions cannot? So this is a very good question. And actually, I originally have another slide to explain this question, but due to the time limit, I delayed that one. But the key idea is that by the underlying technology behind this blockchain, or the most important feature of this blockchain technology is one is decentralization, which can help you build trust, and also another is cryptography. So basic idea is that in this blockchain case, the tier 2 suppliers will be easier to trust that these blockchain platform provide the correct information, because otherwise, in the case of the leafy green industry example, if disruption happens, this food contamination issues happens, how can we allocate those liability issues among all those tier 2 small farmers? Those farmers may worry that the downstream buyer may control the centralized system, will manipulate the data for their own interest. So if it's decentralized and everyone have a record keeping of all the past history, then you will be able to trust such a system. And also on the other side is because of the privacy issues, and the blockchain, many of the cryptography tools can enable these different levels of privacy, and then in that case, the tier 2 supplier can still willing to join without worried about the potential information leak to those downstream large players. So those are 2 points to your question.
So I may take the next question. So the question is, can you comment on how important blockchain and tokens are to the metaverse that Facebook is creating? Isn't crypto and tokens necessary for the metaverse to succeed? So as far as the metaverse is concerned, I'm not quite sure if crypto and tokens will be necessary. So one criteria that would make blockchain a good fit for your enterprise or for your project is that your platform or your project contains many microtransactions. So when there are many transactions and when we have tokens, then these two would be the perfect match. So if Facebook's metaverse contains that type of business, like a lot of microtransactions between users, then tokens might help. But other than that, I don't think blockchain would be necessary. So that's my take. Maybe Fasheng has something to add.
Sure, I want to add one more point to this metaverse issue. I think in order to make metaverse work, we need NFT. So not only blockchain, but also this NFT. I think the key issue for the metaverse to work is that we need to have the key kind of point is we need to define digital assets, digital property rights. So essentially, in a centralized world, when we have these kind of scheme in our games or other types of different collections on a centralized system, the advantage, the disadvantage of that, we will not be able to trade because we don't literally own those assets. But if we put on the blockchain, in particular, if we use those let's say the weapons you get in the game as an NFT, then you will be able to trade, and that will create a huge kind of market for trading, versus in the current gaming setting, the centralized setting, you can just buy and you cannot trade with others for those digital goods. So once we have a digital property rights, we were able to trade, and then that will generate a huge revenue stream in addition to the traditional like first sell in the traditional setting. Yeah. So there are many other questions, so probably we only have time for one more question. Someone, so there one audience asking, can you describe the difference between equity tokens and the stocks? So Rowena, do you want to talk about this question?
So they're very similar in the sense that each of them, so each equity token or each stock represents some physical assets or something that has value. And the main difference is that equity tokens in this sense, so if you think about an ICO versus an IPO, right? ICO is for early stage startup companies. And while IPO is for some mature companies that with some scale. And one important difference is that writing an ICO doesn't need a third party because everything is online on the blockchain. We don't need a third party. We don't need a bank. But if you want to write an IPO, then to underwrite an IPO, it is a very lengthy and it is a very expensive process. And we need someone in between. So that would be an investment bank. That would be the main difference.
Yeah, so also want to add one quick comment to this question. I think both, it's important to notice that in the United States, both equity tokens and stocks are regulated. So it's still under regulation. Yeah.
Right.
So it's almost 1 hour. Should we conclude? Okay, so I see there's another question talking about, do you see blockchain being used as a way to tokenize via of lending? Is it already happening? I think it is already happening, and there are a lot of oh, I should click on this one. There's a lot of applications in the trade finance domain, or this is a subcategory in the supply chain management where people are trying to figure out different types of applications of tokens of blockchain in these transactions among the different parties within the supply chain. And bill of lending is important kind of document where we can tokenize that, and I think the benefit of that is to basically improve the efficiency of the whole process, and the other is to make the accuracy or the trustworthiness of the original document compared to the traditional paper-based documents. So it's already happened. Okay, so given the time limit, so let's stop here. And I would like to thanks again to our guest speaker, Whitman, and also thank you for thanks to everyone for joining us today. And thank you for those wonderful questions. And we will post these recordings, and also don't mention that we will be sharing the slides as well. So let's keep in touch. If you have any further questions, feel free to reach out to us, and we will be happy to have further discussions offline. Thank you, everyone.